And today, we are discussing unit number 13. Unit number 13, it is the vast topic of the entire BFM syllabus. Already we have covered horizontal and vertical disallowance in the previous lecture, and in this lecture we will cover some more important points using MCQs. So let's get started with our first question. The first question you can see on your screen. So we will understand the concept. The question says that as per RBI guideline, how frequently must bank make Pillar 3 disclosure regardless of whether financial statement are audited or not, right? So option says that annually, option B says that half yearly, option C says quarterly, and option D says only when financial statements are audited. So type your thought in the chat box. Is it A, B, C, or D? What do you think? The correct answer to this particular question. So here we are talking about something pillar 3 disclosure, as you can see. So pillar 3 disclosure. So banks should disclose their financial risk regularly. You know it very well, right? So investors and regulator need to see how much risk a bank is taking, and that is why RBI has made it mandatory for bank to disclose the key financial risk, right? So question is how frequently the bank should make pillar 3 disclosure, right? What do you think? Let me see what answer are you giving. So option number A. Okay. Please, all are requested to type whatever they think is correct. Is it A, B, C, or D? Right. So it ensures that bank are not hiding any major risk from the public. That is the main purpose of this pillar 3 disclosure. You know it very well, right? So the correct answer to this particular question is option number B, right? Option number B is the correct answer. That is half yearly, right? The correct answer to this particular question is option number B. That is half yearly. That means disclosure is to be made half yearly basis. Okay, so bank must disclose their financial risk twice a year, even if their financial statement have not been yet audited, right? So twice a year they have to uh, disclose their financial statement. Now transparency is the key point here. Why they need to disclose? For the key point here is the transparency, right? Because regular transparency is the key to maintaining trust in the banking system, right? Now tell me, do you think that more frequent disclosure help in preventing financial crisis? Yes or no? I'm asking you a question. Do you think that more frequent disclosure help in preventing financial crisis? What do you think? Yes or no? Right. So that is why the correct answer to this particular question is option number B. यानी कि ऑप्शन नंबर बी हमारा सही जवाब है, क्योंकि हाफ ईयरली बेसिस पे पिलर 3 डिस्क्लोजर का करना होता है सभी बैंकों को, राइट? ऑब्वियसली यस, राइट, क्योंकि ऑब्वियसली इफ फ्रीक्वेंटली डिस्क्लोजर हैपन देन इट हेल्प्स इन प्रिवेंटिंग फाइनेंशियल क्राइसिस, राइट? एंड if the bank skip it half yearly disclosure, right, so RBI will take action. यदि बैंक अपने हाफ डिस्क्लोजर को स्किप करेंगे तो RBI उस पर एक्शन लेगी, right? And disclosure is always done half yearly. RBI mandate them half yearly to balance transparency and practicality. So what we learn from this question, इस क्वेश्चन से हमने क्या सीखा कि पिलर 3 डिस्क्लोजर इंश्योर करता है कि बैंक अपने की इंफॉर्मेशन को पब्लिक के साथ शेयर करे, राइट? And RBI mandate that this disclosure happen every 6 months, even if financial are not audited, right? So this is the question. Now let's see, move to the second question. So second question you can see on your screen. So it says that a bank XY, a bank. So this question is regarding leverage ratio, right? I think you are familiar with this ratio, so-called leverage ratio, right? So this question is regarding leverage ratio. So question is, imagine as you can see the question, XYZ bank, right? It has tier 1 capital. How much tier 1 capital is there? It has tier 1 capital of $200 billion, right? Tier 1 capital, you can see $200 billion, and total exposure is 400 billion. Total exposure is how much? It is 400 billion. Sorry, $4 billion. You can see total exposure is $4 billion. And now leverage ratio is given. So tier 1 capital is $200 million, total exposure is $4 billion, and they currently operate with a leverage ratio of 5%. Fine. Now here is the twist. Twist क्या है? Suppose XYZ bank decide to increase its lending. It decide to increase its lending, right? Lending. And total exposure risen to $4.5 billion. But tier 1 capital stays the same, maintaining the same tier 1 capital. Now, question is what happened to the leverage ratio? Option A says that it increases, making the bank stronger. Option B says that it decreases, right, leading to regulatory concern. Option C says that it stays the same since exposure does not matter. And option D says that the bank automatically qualify as a systematically important bank. सो फ्रेंड्स यहाँ क्या हो रहा है कि बैंक XYZ है, इसका टीयर 1 कैपिटल दे रखा है, टोटल एक्सपोजर दे रखा है और 5% का लीवरेज रेशियो से ऑपरेट हो रहा है ये। और फिर क्या एक ट्विस्ट आया कि XYZ बैंक ने अपने लैंडिंग को बढ़ाना का सोचा और इस कारण से इनका एक्सपोजर बढ़ के $4.5 बिलियन हो गया। पहले ये $4 बिलियन था, राइट। और टीयर 1 कैपिटल वही का वही रहा, तो लीवरेज रेशियो पे क्या इफेक्ट पड़ेगा? सो बिफोर आंसरिंग दिस क्वेश्चन यू मस्ट नो व्हाट इज द मीनिंग ऑफ लीवरेज रेशियो। आपको पता होना चाहिए कि लीवरेज रेशियो क्या होता है, व्हाट इज द मीनिंग ऑफ दिस लीवरेज रेशियो। सो इमेजिन यू हैव $200 in the form of saving. Imagine you have $200 in the form of saving, right? And a friend asks to borrow $400 from you, right? You have $200 in the form of saving and a friend asks to borrow $400 from you. It sounds risky, right? Because your actual money is way less than what you are lending, right? So you have $200 in your saving and your friend asks you to borrow $4,000. Your friend asks you to borrow $4,000, so it is risky. So bank face the same situation. The leverage ratio help us measure how much a bank is relying on its own capital versus how much it has borrowed. You know the formula of leverage ratio? The formula of leverage ratio is quite simple. It is, the formula is tier 1 capital upon total exposure, right? The formula is tier 1 capital upon total exposure, right? So this is the formula to calculate the leverage ratio. In the numerator we always write tier 1 capital and in the denominator we write the exposure. So bank must maintain a minimum leverage ratio to ensure that they are not taking excessive risk. Now tell me, type your answer. What do you think is the correct answer here? So can you tell me what is the new leverage ratio after this twist? After this twist happen, what is the new leverage ratio? नया leverage ratio क्या होगा? Can you tell me? So first of all, you should know the formula of leverage ratio. Then only you can answer it. The formula of leverage ratio is in the numerator we write. Numerator में हम क्या लिखते हैं? Tier 1 capital, right? In the numerator we write this tier 1 capital, and in the denominator we write this total exposure, right? So after the change, what is the new leverage ratio? So what is the tier 1 capital? Tier 1 capital is 4. Tier 1 capital, you can see it is $200 million. Tier 1 capital does not change, right? Maintaining, question में लिखा हुआ है maintaining the same tier 1 capital. So it is $200 million, and this 200 has to be divided by 4.5 billion dollar, because exposure has changed to 4.5. So it has to be divided by 4.5. Can you do the calculation? What is the value of 200 divided by 4.5? Please let me know in the chat box. What is the value of 200 divided by 4.5? Because you know the formula of leverage ratio is quite simple. You need to divide the total tier 1 capital by total exposure. So tier 1 capital is 200 and total exposure is 4.5. So what value you will get after division? So I am getting 4.44, right? Are you getting the same? I am getting 4.44. Please let me know in the chat box. Are you getting the same? So leverage ratio I am getting is 4.44. Right? I hope you are also getting, yes, 4.44. Very good, very nice. So now tell me what is happening here. यहाँ क्या हो रहा है कि पहले leverage ratio 5% था, अब वो घट के हो गया 4.44. That means leverage ratio dropped, right? So it means that leverage ratio dropped. Earlier it was 5 and now it dropped to 4.44. So bank is now at a higher risk of regulatory scrutiny, because since the leverage ratio dropped from 5 to 4.44, right? So it means that bank is at higher risk of regulatory scrutiny. So lower leverage means bank has less of its own money backing up a loan which can be risky, right? यदि leverage ratio कम होगा इसका मतलब ये होता है कि बैंक के पास अपने अपना पैसा कम है to back up the loan. Bank have less money to back up your own loan, right? So now tell me, does a lower leverage ratio means bank is safer or riskier? Please type safer if you think it is safer, and please type riskier if you think it is riskier. My question is, if leverage ratio is lower, does it means bank is safer or bank is riskier? What do you think? Is it safer or is it riskier? Please let me know in the comment section, in the chat box. So if leverage ratio is low, what do you think? Is it safer or is it riskier? Obviously it is risky, right? A low leverage makes a bank riskier. That is why regulator watches closely. Okay, now so friends, let's see the option here. In the option, the correct answer, we will answer it, right? The correct answer to this particular question is option number B. The leverage ratio decrease. I hope it is clear now, because earlier it was 5 and now it has decreased to 4.44%. That is why leverage ratio has decreased. Now let me ask you one more question. If a bank want to improve its leverage ratio, if a bank want to improve its leverage ratio, so what it should do? Option A, it should increase its tier 1 capital, or option B, it should increase its total exposure. What do you think? What bank should do? If a bank want to increase the leverage ratio or improve the leverage ratio, what it should do? Please type A or B. Improve LR. How banks should improve LR? Should it increase tier 1 capital or should it increase total exposure? What do you think? Option A or option B? Option A. Yes, correct. Very good. Because the formula is quite simple. That leverage ratio formula says that in the numerator we write tier 1 capital, in the denominator we write exposure. So if we increase tier 1 capital, this LR will automatically increase, right? Now, if a bank leverage ratio drop too low, so do you think that regulator will ignore it or take action? What do you think? If the bank leverage ratio drop too low, then what do you think? What will regulators will do? Option A, ignore it. Option B, take action. What do you think? So let me ask you a question. If a bank leverage ratio drop too low, what the regulator will do? Will they ignore it or will they take action? Option B. What do you think? Yes, obviously take action, right? So basically regulator will step in to ensure that bank does not take excessive risk. So from this question, what we have learned is that leverage ratio is important for measuring a bank financial strength, and increasing exposure without increasing capital lower the leverage ratio. And the regulator keep an eye on leverage to prevent excessive risk, right? So this is how they do it. Just wait a minute, because I can see some message coming from people. They are not able to attend the live session. I'm just continuing the session in just 1 minute. Okay, fine. Now let me continue our discussion with the next question that we have. The question number 3 of today's session is, this is the question, right? The question says that the Reserve Bank of India (RBI) has recently relaxed the leverage ratio requirement for DSIB from 4.5% to 4%. Right. So this is an information which has been given to you, and this change aim to encourage bank to expand their lending activity in challenging economic environment, right? So this is the question that is happening, that has been given. Now question is, what could be an impact? How might the regulatory change affect the overall stability of the banking system in India? Right. Option A say it will enhance stability by ensuring bank have more capital available for lending. Option B, it could lead to increased risk-taking behavior among bank, potentially undermining financial stability. Option C, it will have no impact on stability since all banks already exceed the minimum requirement. And option D, it will reduce competition among banks as they will have more capital at their disposal. So what do you think is the correct answer here? So basically what has happened, that earlier leverage ratio was 4.5%, and now it has decreased to 4%. So what will be the impact of this? So let me give you an example to understand this leverage ratio more clearly. So imagine you want to buy a house worth 1 crore, okay, but you only have rupees 10 lakh. You only have rupees 10 lakh with you. The rest rupees 90 lakh you will take as a loan from the bank. So your own money, this is 10 lakh, right, is like the capital that you have. So this is like a capital, right? And the house and the total house price, which is 1 crore, this is your total exposure. This is your total exposure, right? Now if you borrow even more money and put in less of your own, your financial risk increase, right? Right, suppose instead of 90 lakh you borrow 95 lakh and put only 5 lakh of yours, so your financial risk will increase. That is exactly how the leverage ratio work for the bank, right? Okay, just wait a minute, because I'm just refreshing the session, because some people are not able to join the session. There is an issue. Let me just refresh. So okay, so let's discuss. Let's continue our discussion. So what happened in this case, that bank RBI had a rule that, what is the meaning of DSIB? What is the meaning of this DSIB? Can you give some example of this DSIB, domestically systematic important bank? So RBI has a rule that big bank, that is DSIB, they must maintain a leverage ratio of at least 4.5%, right? So it means that for every 100 rupees exposure, so when I say 4.5% leverage ratio, it means for every 100 rupees exposure, they need at least rupees 4.5 capital of their own. But RBI has relaxed the rule to 4% to help bank lend more. Now tell me, what is the correct answer? Is it A, is it B, is it C, or is it D? What do you think is the correct answer here? Yes, correct. SBI, ICICI, HDFC. Very good. So these are the DSIB. So the correct answer to this particular question is option number B, right? Because it could lead to increased risk-taking behavior among bank, potentially undermining financial stability. You know why? Because a low leverage ratio means bank can lend more with the same capital, right? Because the formula of leverage ratio is like this. So correct answer is to this question is option number B, right? So let me explain why option number B is there correct. Because leverage ratio is, what is the formula for leverage ratio? Then the formula for leverage ratio is what? Tier 1 capital, right? Tier 1 capital upon exposure, right? So if leverage ratio is lower, it clearly means that bank can lend more with the same capital, right? Means exposure is higher. So this might encourage bank to take on more risk to increase profit. And if too many risky loans go bad, bank could face financial trouble, and that could impact the entire economy, right? So that is the point. Now let me ask you one question. Do you think that RBI decision will allow bank to lend more? Yes or no? My question is, do you think that this RBI decision will help bank to lend more? What do you think? Is it yes or is it no? So RBI has decided to reduce the leverage ratio from 4.5 to 4. So do you think that this decision will help bank to lend more? Obviously yes, right? Because if we lower the leverage ratio, right, it will, if will lowering the leverage ratio means bank can expand their lending, right? They can, obviously, यदि हम lending ratio को leverage ratio को कम कर रहे हैं, 4.5 से 4 कर रहे हैं, right? So bank lending will increase, right? So bank can expand their lending, okay? And now, does this mean that bank will automatically become unstable? Yes or no? क्या इसका मतलब ये होता है कि बैंक ऑटोमेटिकली अनस्टेबल हो जाएगा? मतलब मान लीजिए कि हम लीवरेज रेशियो को 4.5 से 4 कर रहे हैं, इफ यू आर मेकिंग दिस लीवरेज रेशियो फ्रॉम 4.5 to 4, does it mean that bank will automatically become unstable? Yes or no? Obviously no, because risk obviously increase, risk is increasing, but it does not mean that bank will fall immediately. इसका मतलब ये नहीं हुआ कि बैंक तुरंत फॉल कर जाएगी. They must be cautious, right? So now, should RBI monitor bank more closely after reducing the leverage ratio? Right. my question is, should RBI monitor bank more closely after reducing the leverage ratio? The answer is yes, right? Because increasing supervision is key to maintaining the financial stability, right? So what we learned from this question, that the leverage ratio control how much a bank can lend compared to its own capital, right? So leverage ratio is formula is tier 1 capital, tier 1 capital upon, this total exposure, right? So this leverage ratio control how much a bank can lend compared to its own capital. RBI has relaxed this rule from 4.5 to 4% to help bank lend more. आरबीआई ने क्यों रिलैक्सेशन दिया? ताकि बैंक ज्यादा से ज्यादा लोन दे सके, right? It will boost economic growth, but it also increase the risk of financial instability. Safe haven bank operate in a jurisdiction where the regulator require both CCB and triple CB, right? So safe haven bank currently at CET1 of 7.5%, and due to increased profitability, the bank management is considering to is considering a significant increase in dividend payout to the shareholder, right? So the rule is that they must maintain a minimum capital ratio, minimum CCB before distributing profit, right? So let's see the question first. The question says that based on the Basel III framework and bank CET1 ratio, what is the minimum percentage of earning that safe haven bank can distribute as dividend without facing restriction? Is it 0%, 40%, 60%, or 80%? Right. So if everything is okay, please type all okay in the chat. If you are able to, if audio and video is okay. So, what do you think? So, before answering this question, let me explain you. Audio and video are okay. Okay. I am. Are you able to hear my voice? Am I audible to you? Please let me know. Please let me know if I am audible to you. Okay. Am I odd? I'm not getting. Okay, fine. Everything is okay. Okay, great. So now, so yeah, here you can see that this bank has a CET1 ratio of 7.5%, right? So this bank has CET1 ratio of 7.5%, and management is thinking about increasing their dividend payout, but there is a rule that they must maintain a minimum CCV ratio before distributing profit. So you can think of this CET1 ratio as a financial health meter for a bank. The higher the CET1 ratio, the higher the CET1 ratio, the healthier the bank. You must know it. The healthier the bank, right? But regulator want bank to be cautious. So there is a rule that if a bank has low CET1 ratio, right? If a bank has low CET1 ratio, it means it means they can't give out too much profit. That means they can't give out too much profit in the form of dividend, right? So they must first save money to stay strong. And there is a table in your book. You will see there is a table. Let me show you this table. So this table, question based on this table has been asked frequently in the examination, right? So this table shows how much of their earning bank must save before distributing dividend. Let's look at the safe haven position, right? So you must know this table, you must remember this table. I request you to please remember this table, because question based on this table are asked every year. इस टेबल पे क्वेश्चन हर एक साल पूछा जाता है, तो आपको ये टेबल याद होना चाहिए. अब कैसे याद होना चाहिए, मैं आपको याद करवा देता हूँ. देखिए, बहुत सिंपल है याद रखना. You start with 5.5, right? You start with 5.5 and you add 1.25, you will get 6.75. So this is this one. And from 5.5 to 6 and 6.75, minimum cap CCV is 100%. Now You add further 1.25 to 6.75, you will get 8.0. So here it is written 8.0. And for from this range 6.75 to 8.0, the CCB is 80%. Now you further add this 1.25, you will get 9.25, which you can see here. So for this range 8 से लेके 9.25 में जो आपका सीसीबी है वो 60% का होगा. आप फिर उसमें 1.25 ऐड कर दीजिए. You add further 1.25 to 9.25, you will get 10.50, जो कि आप यहाँ देख सकते हैं, राइट. और 9.25 से लेके 10.5 तक में 9.25 to 10.50, CCB is 40%. You further add 1.25, you will get that is for greater than 1.5, this one. I hope you can remember it. You must remember this table, because you know directly question is asked. आपको ये table नहीं दिया जाएगा. The such table will not be given. It is given in your book, and for the last 2 times I am seeing this question is being asked. So this is very important table, and based on this table only we can answer. I hope you can remember. You start with 5.5, and for 5.5 to 6.75, 180 decrease by 20%. You see, we are decreasing by 20%, 180, 60, 40, and then finally become 0. Now let's come back to this question. Now let's look at this situation of the safe haven bank. Now what is CET1? What is the CET1 of safe haven bank? The CET1 of safe haven bank is 7.5%, right? Now can you tell me, since this CET1 is 7.5%, according to the table, how much of its earning it must conserve? माई क्वेश्चन इस बैंक का CET1 जो है 7.5% है, तो अपने अर्निंग का कितना परसेंट वो कंजर्व करेगा? सो यू कैन लुक एट दिस पार्टिकुलर टेबल. इट लाइज इन दिस रेंज. ये कौन से रेंज में लाई कर रहा है? दिस रेंज इट इज लाइंग 6.75 to 8%, because CET1 of this bank is 7.5%, so it lies in the range 6.75 to 8%, right? So as per this table, it must conserve 80% of his earning, right? So it must conserve 80% of earning. That is the point, right? 80% of the earning it must conserve. So maximum they can so how much? What is the maximum they can distribute as a dividend, right? Can you tell me what is the maximum they can distribute as a dividend? So they must conserve 80% of the earning, right? So the correct answer is 80% of the earning. Very good. The 80% of the earning they can distribute. Very nice. So that means safe haven bank must keep 20% and give out the rest as dividend. Very nice. So 80% is the correct answer. So option number D is the correct answer. Very good. Right. Option number D is the correct answer. Now let me ask you that suppose instead of this 7.5%, if the bank has CET1 of 6%, if the bank has CET1 of 6% instead of 7.5%, right? Do you think they can distribute dividend freely? Yes or no? Suppose CET1 is 6%, not 7.5%. Do you think that they can distribute dividend freely? They can distribute dividend freely? Yes or no? What do you think? No, obviously no, right? Very good. Obviously no. So you must know that because a bank with CET1, if it is 6%, then it lies in this range. If it is 6%, then it lies between 5.5 to 6.75, right? So this they have to save. They must save 100% of their earning. They must save 100% of their earning, right? And now, if the bank has CET1 ratio of more than 10.5%, do they have any restriction on their on dividend payout? Yes or no? Suppose a bank has CET1 of 11%. Now, my question is, do they have any restriction on dividend payout? Yes or no? Yes, if they have restriction. No, if they don't have any restriction. My question is, यदि किसी बैंक का CET1 11% है, right? Do they have any restriction on dividend payout? The answer is no, because bank above 10.5% CET1 have 0% conservation requirement, right? So these rule make the banking system safer. So what we learn from this question is that CET1 ratio is a measure of bank financial strength. जो हमारा CET1 रेशियो होता है वो बैंक के फाइनेंशियल स्ट्रेंथ का मेजर होता है, राइट? द लोअर द CET1 रेशियो, द मोर अ बैंक मस्ट सेव बिफोर पेइंग डिविडेंड. जितना कम CET1 रेशियो होगा, जैसे आप ऊपर जा रहे हैं, एज यू मूव अपवर्ड CET1 रेशियो डिक्रीज एंड द मोर बैंक इज सेविंग, राइट? द मोर बैंक मस्ट सेव बिफोर पेइंग डिविडेंड. So this safe haven bank with 7.5% CET1 can distribute 80% of its earning, but must save 20%. Right. So this rule ensure that uh, bank don't give away too much profit. Right. Now let's see the second question. The second question related to this particular discussion is, I hope this concept is clear now. This is regarding the global growth bank, right? So this is regarding the global growth bank. So the bank called Global Growth, as you can see, it was doing a great with a strong CET1 ratio of 10.6%. It was having CET1 ratio of 10.6%, right? But suddenly, due to loan default, the CET1 ratio has fallen to 9%. Now the bank management is wondering, can we still go ahead with the share buyback? Can we still go ahead with the share buyback? So earlier the CET1 ratio was 10.6%, but it decreased to 9% because of the loan default. And the bank management is worried that can we still go ahead with the share buyback? So let us see the options that we have. Given the decrease in global growth bank, what restriction will the bank face regarding share buyback? Option A: the bank faces no restriction on share buyback. The bank can only use 40% of its earning for share buyback. The bank can only use 60% of its earning for share buyback. And then option number D: the bank must suspend all share buyback. So these are the four options given before you. So you can think of this CET1. आप CET1 को सोच सकते हैं. You can think of CET1 as the bank safety cushion, right? You can think of it like a bank safety cushion. The higher the CET1, the more financially stable the bank is. But bank can't just spend all their earning if their CET1 ratio drop. यदि किसी बैंक का CET1 रेशियो घट जाए तो बैंक अपने सारे अर्निंग को स्पेंड नहीं कर सकते, right? So the rule is that if CET1 ratio is high, bank can freely distribute profit through dividend, bonus और share buyback. यदि CET1 रेशियो ज्यादा है तो बैंक अपने प्रॉफिट को आसानी से डिस्ट्रीब्यूट कर सकते हैं. कैसे? शेयर के माध्यम से, बोनस के माध्यम से, बायबैक के माध्यम से. बट इफ CET1 ratio fall, bank must hold back some earning to stay financially strong, right? So in this case, what is happening? Earlier, its CET1 was 10.6. Now it decreased to 9%, right? So they must follow capital conservation rule, right? So they must follow capital conservation rule. So tell me, what is the answer to this particular question? Right. So before answering this question, let me ask you a few questions. Right. Answer अपने आप आ जाएगा. Before answering this particular question, let me ask you a few questions. My first question is, do you think that a bank with low CET1 ratio should spend all its earning on share buyback? क्या आपको लगता है एक बैंक जिसका CET1 रेशियो कम है वो अपने सारे अर्निंग को शेयर बायबैक पे स्पेंड कर दे? Should a bank with lower CET1 ratio should spend all its earning on share buyback? Yes or no? The answer is no. Why? Because bank need to maintain financial strength, right? Yes, obviously. And my second question is, if the bank CET1 ratio fall below 8%, suppose it fall to 7%, do you think that it can still distribute profit freely? यदि मान लीजिए किसी बैंक का जो CET1 रेशियो है वो 7% हो जाए, सपोज द CET1 रेशियो बिकम 7%, तो क्या आपको लगता है कि बैंक अपने प्रॉफिट को फ्रीली डिस्ट्रीब्यूट कर सकते हैं? कैन द बैंक स्टिल डिस्ट्रीब्यूट प्रॉफिट फ्रीली? यस और नो? राइट. Obviously no, right? Because bank with CET1 below 8%, they face a strict restriction. Now, since global growth bank CET1 is at 9%, is it at currently 9%? So do you think that they can use 100% of their earning for share buyback? Do you think that they can distribute 100% of their earning for share buyback? So in this particular table you have seen from 8 to 9.25%, right? They can conserve 40% of their earning, right? They can conserve 40% of their earning, right? 8 to 9.25, they can conserve. Minimum capital conservation ratio is 60%, so they can conserve 40% of their earning, right? So now the correct answer to this particular question, you are saying option number B, right? Sorry, not 40%. I think it is 60%, right? So according to bank regulation, a bank in this range must conserve 40% of its earning and can only use 60% for distribution like share buyback. You can see there that minimum capital conservation ratio as a percentage of earning is 60%. So the correct answer to this question is option number C. The bank can only use 60% of its earning for share buyback. Right. So bank must conserve 40%. You can see here 40% written. So this 40% they must conserve, right? And this 60% they can issue for share buyback. Yes, ऑप्शन नंबर सी इज द करेक्ट आंसर. 40% उन्हें कंजर्व करना पड़ेगा और 60% जो है वो अपने अर्निंग का शेयर बायबैक के लिए यूज कर सकते हैं. दैट इज द पॉइंट हियर, राइट? Now, let's see another question here. Another question based on the same data. So here the question is, so I hope it help you understand CET1 ratio in the easiest way possible. Now, Sunrise Bank. So this question is regarding the Sunrise Bank, right? So Sunrise Bank, which operate under RBI, and regulator want bank to maintain a safety buffer, right? Safety buffer is CCB of 2%. Right, CCB, that is capital conservation buffer of 2% and triple CB of 1%. Right. Sunrise Bank currently has CET1 ratio of 7%. So CET1 ratio is given 7%. You know, the bank is profitable and wants to distribute its earning while adhering to the regulatory limit. Right. Like paying bonus, like buyback shares, etc. So but the big question is, how much can they actually distribute without breaking the RBI rule, right? So, what is the maximum percentage of an earning that Sunrise Bank can allocate to necessary distribution without breaching regulatory conditions? 0%, 40%, 60%, and 80%. These are the four options given. And this question has been asked in the previous year. So, let's simplify this. You can think of this bank CET1 as ratio like a fuel tank. You can think of them like a fuel tank. आप इसको fuel के टंकी की तरह समझ सकते हैं. If CET1 ratio is higher, it means the bank is safe. It means the bank is safe and can distribute more profit. They can distribute more profit. And if it is a low, if CET1 ratio is low, it means bank must save more. So the regulator have set a CCB capital conservation rule that tells the bank how much of it earning they must keep and how much they can freely distribute. And now what is the CET1? CET1 is 7%. CET1 is 7%. Right. So CET1 here is the 7%. So what do you think is the correct answer to this particular question? So option you can see 0, 40, 60, 80. So these are the options which is given. So you can see the range in which it is lying. कौन से range में किस range में lie कर रहा है? So it lies in the 6.75 to 7.25. Right. In your book you will see another table. आपने किताब में in your book you will see another table which is table 13.7, right? So you will see another table 13.7. If you have book with you, you can open it and check table 13.7. Right. So Sunrise Bank CET1 ratio is how much? Is 7%. So it fall in this range, 6.75 to 8%, and minimum capital conservation is 80%. Minimum capital conservation is 80%. So it means that it must conserve 20% of its earning, right? And it can distribute 80% of its earning for dividend share buyback. So what will be the correct answer to this question? The correct answer will be option number D, that is 80%, right? The option number D is the correct answer. Very good. Option number D is the correct answer, right? So let me ask you, if the bank CET1 ratio is too low, should it be allowed to pay out all its profit? Yes or no? What do you think? A bank CET1 ratio is very low, right? So should it be allowed to pay out all its profit? The answer is no, right? The answer is no, because bank need to keep reserve for safety. And if a bank has CET1 ratio of 7%, so it cannot distribute 100% of its earning freely. It can only distribute, yes, correct. It must conserve 20% of its earning, and it can distribute 80% of its earning for dividend. right? So that is the point. At 7% CET1, you can see this particular table again. Again referring to this particular table, you can see at 7% CET1, the 80% distribution can be done and 20% must be conserved, right? And if CET1 drops further, the conservation ratio increases, reducing the further amount the it can distribute, right? So that is the point. Now let's see the next question. The last question I hope regarding this. So this is the global regarding the Global Harvest Bank, right? So this is regarding the Global Harvest Bank. So Global Harvest Bank is operating with CCB of 2.5% and triple CB of 1%. It initially maintained a robust CET1 of 9.5%, and due to unexpected economic downturn, CET1 has decreased to 7.5%. Earlier, CET1 was 9.5 and it decreased to 7.5%, right? So this is what it happened. Now the question is, how will be the decrease in Global Harvest Bank CET1 ratio impact its capital conservation standard, and what restriction might it face? Option number A: the bank face no restriction because CET1 ratio is still above the minimum. The bank must reduce discretionary distribution, limiting them to 40% of the earning. The bank must reduce discretionary distribution, limiting them to 60% of their earning. And option number D: the bank must completely suspend all discretionary distribution. So, what do you think is the correct answer here? So initially it was 9.5%, later it decreased to 7.5%, right? So you can think of this CET1 ratio as a saving account. If your saving are high, you can spend freely. If your saving drop, you need to control your spending, right? So since Global Harvest Bank CET1 now is 7.5%, so they fall into a specific category, and there is a rule for that. So can you tell me that how much they should conserve of their earning? Let me again move to this particular table. So for 7.5% fall in which range? So 7.5% fall, it fall between 7.25 to 8.125. Because in your book you will see another table which has been given. There had been recent right. So it fall in this range 7.26 7.25 to 8.125, right? So there is another table in your book. I hope I have not provided that table. If in your book you can see table 13.7, आप अपने book में table 13.7 देख सकते हैं, right? In that table it is written that we are here. Yes, in that table it is written that a bank falling in this range from 7.25 to 8.125, 7.25 to 8.125, right? So they must conserve 40% of their earning. They must conserve 40% of their earning. So it means they can distribute only 60% of their earning, right? For dividend. Conservation ratio is 40%. So they can distribute 60% only, right? So the correct answer to this question is option number C, right? So I request you to please check your page number. Let me write down page number 352 of your book. आप पेज नंबर 352 देखिए, उसमें टेबल नंबर 13.5 है, राइट? So it clearly specify that for a bank having CET1 ratio in the range 7.25 to 8.125, it must distribute 60% of its earning, right? So option number C is correct here. Right. So that's all about this particular case study regarding the CT1. Let's move to our next question. This question is regarding ICAAP, right? Internal Capital Adequacy Assessment Process. So let's discuss this particular question. The question says that a mid-sized bank submitted ICAAP report to the regulatory authority, right? So who is regulatory authority? I think it is RBI. So it submitted ICAAP report to the supervisory authority, and the report shows that the bank has enough capital to cover its risk. But the supervisors notice that some assumption in the risk model don't seem reliable, right? So there are some assumption in the risk model which don't seem reliable, right? So this is the question. So what should the regulator do next? That is the question. So earlier what happened that it submit ICAAP report regularly, and report shows that bank have enough capital to cover its risk, but supervisor noticed that some assumptions in the risk model do not seem reliable, right? So options, let's see the option that we have. What should supervisory authority do if they're not satisfied with the bank ICAAP report? Accept the report as it meets the minimum regulatory requirement. Option number B, that conduct an on-site examination and require the bank to revise ICAAP based on finding. Option number C, allow the bank to operate without any further scrutiny. Option number D, provide a warning but take no further action. So you can think of a bank like a ship sailing in an ocean. To ensure that ship does not sink, the capital needs enough lifeboat, right? That is capital. An ICAAP report is like a safety check report. It is just like a safety check report, right? It is like a safety check report. It tells regulator if the bank has enough capital to survive financial storm, right? So, if a bank say that it has enough capital, should supervisor trust it 100% without checking? The answer is no. It cannot trust because supervisor must verify the assumption. And if ICAAP looks report looks good on paper but has faulty risk assumption, could the bank still be at risk? This is my question. My question is, if ICAAP report looks good, right? ICAAP reports looks good, but it has faulty risk assumption, right? Should the bank still be at risk? Yes or no? What do you think? Report looks good, but the assumption are faulty. There is some fault in the assumption. So, could the bank still be at risk? The answer is yes, because incorrect assumption can lead to underestimating the risk. If you take incorrect assumption, it could lead to underestimating your risk, right? So regulators should take action if they see potential issues in the bank risk assessment. Now, let us see the correct answer, right? So here you can see the supervisory team is not fully convinced that the bank ICAAP risk assumption. So their job is to double check the number and ensure financial stability. So they should double check the number, and the best way to do is to on-site examination. Yes, option number B is the correct answer, right? They should conduct on-site examination, right, and requiring the bank to revise it ICAAP based on real finding. So the correct answer is option number B. So what we learned from this question, that ICAAP is like a bank financial safety report, and supervisor don't just accept the report blindly; they verify the assumption behind it, right? And if the risk assumption it appears weak, supervisor must step in and conduct an on-site review. That is why option number B is the correct answer. Let's move to the next question. So this is the question before you. Very important question we are discussing right now. So what is happening here, that a bank start with a strong capital, enough money to handle risk, but due to unexpected market condition, maybe a stock market crash or bad loan, the bank capital suddenly start dropping. So you can see written here, decline its capital ratio. So bank's capital start declining. Now here is the question: what should the regulator do in such case? Right. Option number A, wait for the next scheduled review before taking action. Option number B, require the bank to submit a detailed capital restoration plan immediately. Option number C, increase regulatory capital requirement without assessing current condition. Option number D, allow the bank to manage its own recovery without oversight. What do you think is the correct answer to this particular question? देखिए यहाँ पे क्या है कि एक बैंक है जो कि स्ट्रॉन्ग कैपिटल के साथ स्टार्ट हुआ था, इसके पास सफिशिएंट मनी था रिस्क को हैंडल करने के लिए, लेकिन अनएक्सपेक्टेड मार्केट कंडीशन के कारण मान लीजिए स्टॉक मार्केट क्रैश कर गया या बैड लोन इन्होंने ज्यादा दे दिया, इस कारण से क्या हुआ, इनका कैपिटल ड्रॉप होना स्टार्ट हो गया। अब रेगुलेटर को एक रिपोर्ट मिलता है जिसमें लिखा रहता है कि कैपिटल लेवल डिक्लाइन कर रहा है, तो रेगुलेटर क्या करे, आपके सामने चार ऑप्शन दिए गए हैं, राइट? तो आप बैंक को समझिए एक तरह का कार है, सपोज यू कैन थिंक ऑफ द बैंक लाइक अ कार, कैपिटल इज लाइक इट ब्रेक, कैपिटल को समझिए ब्रेक की तरह है, राइट, दैट हेल्प्स कंट्रोल स्पीड एंड प्रिवेंट एक्सीडेंट। सो इफ द ब्रेक स्टार्ट वियरिंग आउट, यदि मान लीजिए ब्रेक जो है, कार का जो ब्रेक है वो वियर होने लगे, so the driver fix them immediately or wait for a disaster, क्या करे ड्राइवर, उसको तुरंत फिक्स करे या डिजास्टर के लिए वेट करे, right? Obviously he should fix it. यही चीज बैंक के साथ भी होता है, सेम विद द बैंक ऑल्सो। इफ द कैपिटल स्टार्ट डिक्लाइनिंग, वेटिंग कुड लीड टू अ फाइनेंशियल क्रैश। यदि आप वेट करेंगे, कैपिटल आपका घट रहा है, इस कारण से आपको फाइनेंशियल क्रैश आ सकता है। दैट इज बाय रेगुलेटर स्टेप्स इन। नाउ टेल मी, what is the correct answer to this particular question? What do you think? The bank capital is declining and the regulator must act fast. So what do you think? Please type in the chat box. It is A, B, C or D. So the correct answer to this particular question is option number B, that they require the bank to submit a detailed capital restoration plan. इसमें बैंक को एक डिटेल कैपिटल रिस्टोरेशन प्लान सबमिट करना होगा, राइट? So I hope this is clear. What has to be done in this case? Capital restoration plan is immediate, and this is regarding according to the principle number 4. Friends, I request you that SREP, supervisory review plan, there are four principle in SREP and I request you to mug it up. मैं आपको रिक्वेस्ट करूंगा कि जो आपके SREP के 4 प्रिंसिपल बुक में दिए हुए हैं, आप उसको याद कर लें, बिकॉज क्वेश्चन इज आस्क्ड डायरेक्टली फ्रॉम दिस 4 प्रिंसिपल, एंड दिस इज द प्रिंसिपल नंबर 4, which emphasize proactive measures supervisors should take when a bank capital fall below minimum requirement. This is principle number 4. Question can be like this: which principle it is? So it is principle number 4, right? Now let's see the next question. The next question is on your screen. Very nice question it is. Let's answer this particular question. So what is happening here? That this is regarding the XYZ bank. It has a leverage ratio of 4.7%. First of all, let's see the question. XYZ bank, right? It has a leverage ratio of 4.7%, and want to know how RBI new policy affected, right? How RBI new policy affected. So what is the new policy of RBI? In June 2019, the RBI revised the leverage ratio requirement to support the lending activity. The bank risk management team is now assessing how the change in RBI leverage ratio impacted operation. So what is the leverage ratio here is 4.7%, right? So let's see the first question. Which of the following statement correctly explain the implication of RBI revised leverage ratio for a bank? Option number A, XYZ bank must now maintain a minimum leverage ratio of 4.5% as per the Basel requirement. Option number B, if XYZ bank is categorized as DSIB, it must maintain a minimum leverage ratio of 4%. Option number C, RBI has completely removed the leverage ratio requirement for bank, allowing unlimited lending. Option number D, the Basel committee has set the leverage ratio for all banks at 5% globally, overriding RBI decision. What do you think is the correct answer here? Imagine you are running a small grocery shop, but you have 10,000 of your own money, right? You have 10,000 of your own money, and this is like a bank capital. This 10,000 is like a bank capital, right? But you take a loan of 90,000. You take 90,000 rupees and in the form of loan to expand your business. So what is your total money? Your total money is 1 lakh. 10,000 of your own and 90,000 from the 90,000 of the loan. So 1 lakh is your total money. But only 10,000 is yours. What if sales drop and you can't repay this 90,000 rupees to the bank? You might struggle to pay back the lender. Bank work the same way. They lend a lot more money than they actually own. So RBI set a rule to ensure that bank don't overdo it. And this rule is what we call leverage ratio, right? So my question is, should bank be allowed to lend unlimited money without restriction? Yes or no? What do you think? Should bank be allowed to lend unlimited money without restriction? Obviously no, because excessive lending leads to financial crisis, right? Now my second question is, do you think that leverage ratio is same for all the banks? Do you think leverage ratio is same for all the bank? Yes or no? My question is, do you think that leverage ratio is same for all the bank? Is it yes or is it no? The answer is no, because RBI set different requirement for systematically important bank. And my third question is, does RBI have the power to change leverage ratio requirement in India? Obviously yes, right? So what happened in 2019? You know what happened in 2019? 2019 में क्या हुआ आपको पता है? देखिए हुआ क्या, अर्लियर बैंक फॉलो Basel 3 global standard. So earlier, bank follow Basel III global standard, which says leverage ratio of standard leverage ratio 3%. Earlier, bank follow Basel III guidelines, Basel III global standard, which says leverage ratio to be maintained at 3%, right? But RBI revised it to 4% for DSIB. RBI revised it to 4% for DSIB and 3.5% for other bank, right? So RBI RBI allowed it to. So earlier, before 2019, what is happening here, that before 2019, right, 3.5% for all, that is global standard. But after 2019, RBI allow 4% for DSIB and 3.5% for other bank. Why? To allow bank to lend more while keeping the financial system stable. Now let's come back to this particular question. XYZ Bank has a leverage ratio of 4.7%, right? And the new policy affect, how does it affect it, right? So the correct answer to this question is option number B, right? I told you earlier that earlier 3.5% was mandatory before 2019, but in 2019 RBI changed the policy, right, and said it 4% for DSIB and 3.5% for other bank. You must remember this ratio. Super important. Asked every year. Right. So what is the leverage ratio for DSIB? Answer is 4%. What is the leverage ratio for other systematic bank? Answer is 3.5%. Right. So option number A say 4.5%. This is wrong, right? So as per RBI requirement, as per RBI regulation, it is only 3%. Option number C says that RBI removed the leverage ratio requirement. This is also wrong because RBI revised it but did not remove it. And option number D say bank said 5% leverage for all banks. This is also wrong because Basel III global minimum is 3%, right? Country like India can set a stricter rule but do not override Basel III framework, right? So I hope this make you concept clear. If it is clear, please type clear in the chat box, because this is very important thing to consider, that 3.5% for other bank, 4% for DSIB after 2019. You must remember it, the leverage ratio, right? This is the point which has been raised here. Now let's see the next question that we have. The next question you can see on your screen. It says that bank management is reviewing the capital structure to ensure compliance with Basel III regulation. They currently have significant retained earning and a statutory reserve, but they are considering issuing new common share to enhance their CET1 capital. Right. So they already have retained earning. You know what is the meaning of this retained earning? क्या आपको पता है retained earning का क्या मतलब होता है? Do you know the meaning of this retained earning? Retained earning means that profit they kept instead of distributing. The profit they kept instead of distributing is called retained earning. यानी जो profit उन्होंने अपने पास रखा है distribute नहीं किया है, that is what we call retained earning, right? So they have a statutory reserves, right? They have a statutory reserves with them, which means this is the money they set aside as per the regulation, that is called statutory reserves. Right. So here it is. They already have the retained earning. Retained earning means what? The profit they keep inside instead of distributing. That is called retained earning. You know. And also they have a statutory reserves, means they set aside as per regulation, but they are considering, they want to enhance their CET1 capital. They want to enhance their CET1 capital. You can see it here, right? They want to increase their CET1 capital. So what they can do? Option number C, A say that they should issue preferred share that do not qualify at a common equity. Option number B say selling of non-core asset and using the proceed to boost a statutory reserve. Option number C says issuing common share that meets regulatory criteria for CET1 classification. And option number D say increasing the bank revaluation reserve without conducting a proper revaluation. So these are the four options given before you. What do you think is the correct answer here? So before answering this question, let me provide you some background. So let's simplify this CET1 capital with an example. I think you know about this CET1 capital, but let's take one example to make it more clear about this CET1 capital, what it is all about. So let's take an example. Imagine you are running a shop, right? And you have 50,000 rupees you have 50,000 rupees of your money to buy supply. You have 50,000 money with you to buy the supply, right? This is your real capital. This 50,000 is your real capital. This is your real capital, right? But now let's say a friend lend you rupees 1 lakh. Let's say a friend lend you rupees 1 lakh to expand. But remember, this 1 lakh is not really your money, rather it is a loan. So you have 50,000 earlier with you. This is your real capital, and your friend give you 1 lakh. This is not your money, rather it is a loan. So this CET1 capital, this CET1 capital is like your money. It is like your money. It is the safest and the most reliable part of a bank capital, right? So let me ask you a question. Can a bank count borrowed money as CET1 capital? Yes or no? My question is, can a bank count borrowed money as CET1 capital? What do you think? Yes or no? So, can the bank count this borrowed money as a CET1 capital? Obviously, the answer is no, because CET1 must be bank on money, right? This CET1 must be bank on money. Now, my second question is, do you think that issuing common share can increase CET1 capital? You can see here, it is written issuing common share. They have issued common share. So, do you think that issuing common share can increase the CET1 capital? Yes or no? What do you think? If a bank issue common share, will their CET1 capital will increase? The answer is yes, because selling new share bring in fresh equity, because they are selling share, right? वो शेयर बेच रहे हैं, और शेयर क्यों बेच रहे हैं? शेयर बेच रहे हैं ताकि उन्हें इक्विटी मिले, right? Because selling new share bring in fresh equity. It will bring in fresh equity, right? That is why issuing new share will bring equity, right? So yes, it is correct. My third question is, does Basel 3 allow bank to use any kind of reserve as CET1 capital? Does Basel 3 allow the bank to use any kind of reserve as CET1 capital? Does Basel 3 allow bank to use any kind of reserve as CET1 capital? What do you think? Yes or no? Please let me know. Does Basel 3 allow bank to use any kind of reserve at CET1 capital? The answer is no. Only a specific reserve qualify. Right. So now bank has already the retained earning. Bank already have the retained earning with them. Right. You can see bank already have the retained earning with them. That means the profit they keep instead of distributing. Bank already have a statutory reserve with them, but they want to increase their CET1 capital. So the correct answer to this question is option number C. Right. So what bank can that issuing common share that meet regulatory criteria for CET1 capital, right? So why? Because when a bank sell common share, right? Whenever a bank sell common share, it raises fresh equity, right? Whenever a bank sell common share, it raises fresh equity. जब भी बैंक कॉमन शेयर सेल करेंगे, it raises fresh equity, right? And this directly boosts the CET1 capital, helping the bank meet Basel 3 requirement, right? So let's see other option. Let's see other option also. Option number A says issuing preferred share. Right. Option number A says issuing preferred share. So issuing preferred share. If you talk about this preferred share, so this preferred share is not CET1 capital. This preferred share is not CET1 capital. Right. They usually count as AT1 capital. Preferred share is AT1 capital. Now option number B, selling of non-core asset. This is not selling of non-core asset. Selling asset and using reserve, this is not correct, because statutory reserves are useful, but they do not directly count as CET1 unless they are recognized by the regulator. So option B is wrong. Option D says increasing revaluation reserve. So you can't just increase reserve without actually revaluing asset under proper guideline, right? So the option number C is the correct answer. So what we learned from this question is that CET1 capital is the most important part of a bank capital. Issuing common share is the direct way to boost CET1, and Basel 3 require bank must maintain a strong capital base. That is the learning from this question. Now let's see the next one. I hope it is clear. Now let's do one numerical based question here. The question is in front of your screen. This is a practical question related to CET1 capital calculation in the simplest way possible. So, question is, a financial analyst is assessing a bank CET1 capital composition. The bank has the following component: common share issued, stock surplus from the share issued, statutory reserves, revaluation reserve from property. The revaluation reserves are eligible for inclusion at a discount of 55%. If the total value of the revaluation reserve is $1 million, how much of will be considered as CET1 capital calculation? Right. There are four options given. Right. So option number A, I think it is $4,50,000. Option number B, $5,50,000. Option number C, $6,50,000, and option number D, $10,00,000. So these are the four options given before you. So let's break it down in the simplest way possible. Imagine you have a house worth 1 crore. Suppose you have a house, let me give you an example to make it more clear. Right. So you have a house worth rupees 1 crore. Right. You have a house worth rupees 1 crore. A property expert tells you that the new value of house is 1.5 crore. So property experts tell you that the new value of house is 1.5 crore, right? So this extra 50 lakh is called revaluation reserve. You have a house worth 1 crore, right? And a property experts tell you that now your house is worth 1.5 crore. So this extra 50 lakh is called revaluation reserve because your property is now worth more than before. But wait, bank can't just add the full 50 lakh to their capital. Regulators say, hold on, this is just an estimate. We need a margin of safety. So in banking, only a percentage of revaluation reserves is allowed in CET1 capital. So now, let me ask you a question. Can a bank include 100% of its revaluation reserve in CET1 capital? क्या बैंक 100% अपने रिवैल्यूएशन रिजर्व को CET1 कैपिटल में इंक्लूड कर सकता है? यस और नो? प्लीज टाइप इन द चैट. कैन अ बैंक इंक्लूड 100% of its revaluation reserve in CET1 capital? What do you think? Is it yes or is it no? The answer is no, right? The answer is no because there is a discount applied. And if the discount on the revaluation reserve is 55%, does it mean that only 45% is included? So obviously discount is 55%. So does it mean that only 45% is included? Yes, because 100 minus 55 is 45, right? So the correct answer to this particular question is 45% of 1 lakh, right? The correct answer to this question is how much? 45% of this 1 lakh. So what is the 45% of this 1 lakh? Right. I think it is 10 lakh, not 1 lakh. It is 10 lakh. 1 million means 10 lakh, not 1 lakh. So 1 million means 10 lakh dollar. So if you calculate 45% of this 10 lakh, right? So you will get 4 lakh 50,000, right? You will get 4 lakh 50,000, right? So option number A is correct. Option number A is correct, right? So I hope it is clear that revaluation reserve is always a discount of 55%. So the actual value that will be included in CET1 capital calculation is 4.5 lakh. Is it clear? I hope it is. So what we learned from this question that revaluation reserve are only partially included in CET1 capital. If 55% discount is applied, only 45% is counted. Now in our question, $1 million in revaluation reserves, it means 4 lakh 50,000 was added to the CET1 capital, right? So I hope that makes sense to you. Now let's see the next question. This is another question which is numerical type question. Please try answering it. Right. So this question is regarding AT1 capital. Till now we have discussed CET1. Now let's move to the AT1 capital. So you can think bank's capital as a different layer of safety net: CET1, AT1, Tier 2. Right. So the question says that a bank include the following in the AT1 capital, right? So PNCPS, PNCPS is perpetual non-cumulative preference here. This is called PNCPS. How much is the PNCPS here? $500 million. You can see PNCPS is $500 million, right? And stock surplus from PNCPS is $100 million. So PNCPS is $500 million. Stock surplus from PNCPS is you can see $100 million. Perpetual debt instrument, which is PDI, is $300 million, right? And regulatory adjustment or deduction is $50 million. The question asks you what is the total amount of additional tier 1 capital applying a regulatory adjustment. This is the question, right? So for answering this question, you should know what are included in 81. आपको 81 के अंदर क्या क्या आता है ये पता होना चाहिए, right? You know what is CET1? You know what is 81? Let me just remind you. So first is called CET1. पहले को हम लोग CET1 बोलते हैं. CET1 is the strongest and the primary layer of protection. Think of it like a steel foundation of a building. For a building, there is a steel foundation that is called CET1. Then we have 81. 81 stands for additional tier 1. Right? 81 stands for additional tier 1. So this is the next level of capital that help in emergency. So it help in emergency, right? It help in emergency, but they don't replace the main structure. And after 81, we have something called tier 2. This is extra buffer, but not as strong as CET1 and 81. So now let's focus on 81 capital, right? So my question is, are PNCPS considered 81 capital? Tell me, is this PNCPS, that is perpetual non-cumulative preference here, is this considered 81 capital? Yes or no? What do you think? Are PNCPS considered 81 capital? The answer is yes. Why? Because these shares do not have a maturity date and help absorb loss. Right? Because non-cumulative, perpetual. Why? See this word written perpetual. Perpetual means never ending. That is why they don't have any maturity date. So this they are never ending means they don't have any maturity date. Right? So since this share don't have any maturity date, so they help absorb the loss. So that is why they are considered 81 capital. Right? Now, my second question is, are bank required to repay perpetual debt instrument at a fixed date? This is the perpetual debt instrument. Are bank required to repay perpetual debt at a fixed date? Yes or no? Are bank required to repay perpetual debt as a fixed date? The answer is no. Because they are called perpetual. Perpetual means what? They don't have a fixed repayment date. Right? Now, my third question is, if a bank has suppose let's answer this question. If a bank has suppose 81 as 900 billion, right? If a bank has $900 million in 81 and regulatory deduction, you can see this word regulatory adjustment as $50 million. So what will be the final 81 capital? So you can see $900 million, $900 million is the 81 capital. $900 million is in 81 capital, and $50 million are the deduction. So adjusted 81 capital will be how much? It will be $850 million. It will be $850 million. Now let's answer this question. So we know what are included in 81. अब हमें पता है कि 81 में क्या क्या आता है, right? So in 81 what we get? In 81 we get this perpetual PNCPS, we get this stock surplus, we know this is PDI. So you add all of them, 500 plus 100 plus 300, how much you will get? You will get $900, right? You add all of them, 500 plus 100 plus 300, you will get 900. But we have to adjust this regulatory deduction. So bank must deduct this $50 million. This 50 has to be deducted, right? So bank must deduct this 50. So from 900 minus 50, this will give us how much? 850, right? So the final 81 capital will be how much? $850 million. The correct answer is option number A. Please let me know in the chat if it is clear or not. Yes, option number A is the correct answer, right? So remember, remember this regulatory deduction has to be deducted, right? If a bank has $900 million in 81 capital and regulatory deduction is $50 million, so the final 81 will be, after deduction it will be 850. So you must know what are the things which are included in 81 capital, like PNCPS, like PDI, like a stock surplus from PNCPS, but this regulatory adjustment has to be deducted, right? Now let's see this particular question. The question is on your screen. So what we learned from this question? We learned that 81 capital includes instruments like PNCPS and PDI, and regulatory deduction must always be subtracted before finalizing 81 capital. Right. So I hope it is clear now. So we have covered CET1, we have covered 81. Now let's look at this particular question. The question is that ABC Bank is planning to raise additional capital to standard its CAR. The management is considering different options and issuing PNCPS and PDI. However, some board members are concerned about whether this instrument will be qualified as a regulatory capital under Basel III norms. So they are concerned about it, right? So this question is about how bank use PNCPS and PDI to strengthen their capital adequacy, right? So the question is, which of the following statement is true about the instrument being considered by the ABC Bank? So, option A, PNCPS and PDI are not eligible as regulatory capital and should not be included in capital calculation. Option B, PNCPS and PDI can be included in AT1 capital provided they comply with the regulatory requirement. Option C, PNCPS and PDI can only be included in Tier 2 capital as they are debt-like instrument. Option D, PNCPS and PDI can only be used for funding expansion project and have no impact on the regulatory capital. Right. So before answering this question, let me explain to you what is this all about. You can think the bank as a three-story building, right? You can think bank as a three-story building, right? So when I say three-story building, what I means, suppose this is the ground floor, right? This is the ground floor, this is the first floor, and this is the second floor. So in the ground floor we have something called CET1, which is the strongest foundation as the concrete base. In the first floor, we have the AT1, that is called additional tier 1 capital, a buffer that will absorb financial shock, and it includes PNCPS and it includes PDI. And we have the second floor, which we call as a tier 2 capital, right? So a backup, but not as strong as AT1. Now let's test your understanding. My question is, do PNCPS and PDI have maturity date? Yes or no? Do PNCO, you are answering option B. Okay, fine. My question is, do PNCPS or PDI have maturity date? Yes or no? Answer is no, because PNCPS means perpetual. Perpetual means they don't have any maturity date. Right. Now, my second question is, can bank skip dividend payment on PNCPS? Can bank skip dividend payment on PNCPS without carrying them forward? Can bank skip dividend payment? This is an instrument, PNCPS, perpetual non-cumulative preference share. So can bank skip dividend payment on PNCPS without carrying them forward? Yes or no? Please answer this question because these are very helpful. Answer, you are saying no. This is wrong. The bank can skip because in the name itself says non-cumulative. What is the full form of PNCPS? Perpetual non-cumulative, right? Non-cumulative. You see this word written non-cumulative. Non-cumulative means what? They can skip. Means unpaid dividend does not accumulate. Non-cumulative means what? Suppose a bank skip dividend, that means unpaid dividend does not accumulate. So bank can skip dividend without carrying them forward, right? That is the peculiarity of this PNCPS. PNCPS में क्या होता है, नाम में ही लिखा गया है नॉन कुमुलेटिव, इसका मतलब है कि बैंक डिविडेंड को स्किप कर सकते हैं. Now my third question is, do PDI have to include loss absorption feature like write down? There is something called loss absorption feature like write down or conversion to equity, right? So do PDI have to include loss absorption feature like write down or conversion to equity? Yes or no? Does PDI include loss absorption feature? Yes or no? The answer is yes, because Basel III require PDI to absorb loss in the financial distress. So now let's answer this question. So ABC Bank is considering issuing PNC, right? So ABC Bank is considering issuing PNCPS and PDI. Will this qualify as regulatory capital? Option number A says that PNCPS and PDI are not eligible as regulatory capital. This is wrong. Option number A is wrong, right? Option number A is wrong. Why it is wrong? Because both are recognized as AT1 capital. So it is wrong because both PNCPS and PDI are required as AT1 capital. Option number B says PNCPS and PDI can be included in AT1 capital. Yes, correct. Option number B is the correct one. Option number C say PNCPS and PDI can only include in tier 2 capital. This is wrong. Can you tell me one instrument which are included in tier 2 capital? Please type in the chat box if you know any instrument which are included in tier 2 capital. We know what are included in CT1. We know what are included in our AT1. Now, can you name any one instrument which is included in the tier 2 capital? Just name a one instrument. And option number D says PNCPS and PDI can only be used for funding expansion. This is also incorrect, right? So the correct answer to this, I'm providing you one name. You might have heard of something called subordinate debt. So the subordinate debt, it is a part of tier 2 capital, right? So now you might be wondering, why do bank issue PN, CPS and PDI instead of just raising equity? Because can you tell me equity is a part of which tier 1, tier 2 or CET1? Please answer in the chat box. I'm asking equity. Equity is a part of which capital? Is it CET1, is it 81 or is it tier 2? Please answer it, because you should clearly know what is CET1, what is 81, what is tier 2. This question is asked frequently. Please answer my question. Equity is CET1, 81 or tier 2? No, no, no. Equity is tier 1. Equity is CET1. Equity, equity is CET1. That is common equity tier 1. Right? Raising equity is CET1. You know about equity? I think you know about it. Shareholder, right? You suppose I have a company, I issue some share and you bought those share. So basically what I am doing, I am offering equity, and equity is expensive. My question is, why bank issue PN, CPS and PDI instead of just raising equity? The answer is quite expensive. This equity is very expensive, right? Issuing PN, CPS and PDI help bank raise fund without diluting shareholder control. In this PN, CPS and PDI, shareholder control is not diluted. Shareholder still have the control, and this help meet capital adequacy requirement under Basel number 3, keeping the bank stable even in crisis. And these PN, CPS and PDI act like a shock absorber. They have a loss absorption feature. What it means? That means they absorb loss without pushing the bank into bankruptcy, right? They can be converted into equity, they can be converted into principal write down. That is why Basel 3 require bank to have a strong AT1 capital, right? So what we learned from this question, that PN, CPS and PDI are eligible as AT1 capital if they meet the Basel 3 norms. They must be perpetual, means they have no maturity date, and they must absorb loss when required. And bank use them to strengthen their CAR while maintaining a flexible facility. So tell me, is it clear now? Is it clear that why bank, why instead of issuing equity, bank prefer this PN, CPS and PDI? The reason is that equity being a CET1 capital is quite expensive. बैंक पीएन सीपीएस और पीडीआई को इसलिए प्रीफर करते हैं क्योंकि जो हमारा इक्विटी है ना, वो टीयर 1 कैपिटल होता है और वो बहुत ही एक्सपेंसिव होता है, वो बहुत ही महंगा होता है. That's why, right? So that is the point. That is the point. I hope it is clear now, right? Now let's see the next question that we have. The next question you can see on your screen. The question says that PQR Bank is actively engaged in SFT. What is SFT? Security finance transaction, such as repurchase agreement and security lending. To mitigate the counterparty risk, the bank requires collateral from its counterparty and revalue its position daily based on market variable. Recently, one of its counterparty, Element investment firm, faced liquidity issue and was unable to meet its margin call. The bank risk management team is now evaluating whether its collateral fully covers its exposure. Right. So this is the question before you, as you can see it here. Right. So basically, if you have ever wondered that how bank lend security, manage risk, and use collateral, this question is for you. Right. So this is the question. Which of the following best describe how collateral and margining help in managing counterparty risk in this scenario? Since collateral is collected, PQR bank has no counterparty credit risk and does not need to calculate a capital charge. Option B. Collateral reduces risk exposure but does not completely eliminate counterparty credit risk. Option C. If element investment firm fail to meet its margin call, PQR bank must liquidate all transactions immediately to avoid loss. And option D. SFT, that is security financial transaction, do not require collateral as they are short term in nature. So before answering this question, let me explain what is the meaning of this SFT. You know what is SFT? You might have heard about this SFT. So let me explain what is this SFT. SFT, this is called security financial transaction. So imagine you loan your friend $100. You loan your friend $100, but ask for their gold chain as security. You give $100 as loan to your friend, and you ask for them, suppose a gold chain as security. Your friend promised to return the money in a week, and you will give their gold back. In banking, a similar process happens with repo and security lending. You see this word written here, repo. In banking, similar thing happen with repo and security lending. Bank give money to institution, right? What is happening here? Let's see. Bank give money to institution. So this is bank and this is institution, right? So bank give money to institution, right? And taking security, bank takes security from the institution like bond or stock as collateral. Later the institution return the money and bank give back the security, right? So this is what is called SFT. You should know about this SFT, security finance trading. Now let me ask you one question. Is collateral always in the form of cash, yes or no? So in this case, the bank give money to the institution and in turns takes collateral. My question is collateral always in the form of cash? Yes or no? What do you think? The answer is yes. Collateral can be cash, it can be a stock, it can be bond or any other financial asset. Right? So you must know it. Now in this question, what is happening here? I hope it is clear. SFT is clear. SFT is called Security Finance Financial Transaction. Now in this case, what is happening? That PQR give money to LMN investment. PQR bank give money to its counterparty LMN investment firm and took security as a collateral. Right? They revalue it day to daily to make sure it is enough. PQR Bank gave money to LMN investment firm and took security as a collateral. The bank revalue it daily to ensure that it is enough. The problem is that LMN investment firm is now facing liquidity issue and can't meet its margin call. So what should the PQR bank should do now? That is the question. So let's go through the option. What do you think is the correct answer to this particular question? Option number A says that since collateral is collected, PQR bank has no counterparty credit risk. Option number B says that collateral reduce risk exposure but does not completely eliminate counterparty credit risk. Option number C, that if element investment fails to meet its margin call, PQR bank must liquidate all transaction immediately. Right. So what do you think? Is it A, B, C, or D? So the correct answer to this question is option number B. Right. Collateral reduce risk exposure, right, but does not eliminate it. So how does collateral help? This collateral act like a safety net. This collateral act like a safety net. So if element investment cannot pay, right, PQR bank still had the security. So market price change, if the collateral value drops suddenly, the bank might not recover its full money. So there is a delay in setting collateral, which means losses are possible. So even if collateral is there, the bank still needs to hold capital for counterparty risk, right? It cannot eliminate the counterparty risk. Is it clear? Because collateral, there is a market price may change, because of which bank has to keep separate capital for this credit risk, right? So let me ask you one question. Does collateral value changes every day? Does collateral value changes every day? Yes or no? What do you think? Does the value of collateral changes every day? What do you think? Obviously, yes. Right? Yes. And so banks should hold capital for counterparty risk even if they have the collateral. So what we learned from this question is that SFT stands for Security Financial Transaction. It means lending money against security as collateral. And collateral help reduce risk but does not remove it completely. Market value fluctuation and liquidity risk, right? It make counterparty credit risk an ongoing challenge, and bank must hold capital for this risk even when collateral is in this place. So I hope it is clear now. So that's all for today, right? We have covered in today's session. We have started with the leverage ratio. We have done 2 to 3 numerical on leverage ratio. We have also seen there is a chart which is minimum CCB requirement, right? We have seen against CET1, right? We have seen a table where what should be the minimum CCB requirements against CET1, and also we have seen what are the things which are included in CET1, AT1, as well as your tier 2, right? And finally we have seen the SFT. So if it is clear, right, so I must wrap the session, and the next session I will conduct tomorrow at the same time, right? And the PDF of this session I will provide in the group, Telegram group, and recorded session will be available in your course. So if everything is okay, I hope it was valuable session for you, right? So let's meet together at the same time tomorrow. I hope it was okay. Everything is okay. So was the session helpful or not? Please let me know in the chat. Okay, CET1, 81, 82. Okay, trick. Okay, fine, fine, fine. Okay, fine. So, you see this thing you have to remember. Okay, I will make a separate video on that. Okay, fine. I will make a separate video to remember this CET1, 81, and tier 2. What are the components of these two? Right. I will make a separate video so that you will never forget it. Right. Main thing is that understanding. If you understand each and every term, what is the meaning of PNCPS, what is the meaning of PDI, you can know it. But I can prepare a separate video on that. I will provide that. Okay, so that's all for today. Thank you for attending the session. I am wrapping it up.